All right. Welcome to another macro discussion. And folks, I got a good one for you tonight because we're going to talk about oil. Obviously, oil prices crashed last Friday, and now we have to talk about perhaps peak inflation as oil prices maybe peaked. Maybe this is a good sign for the economy, a good sign for the stock market. We're going to talk about this fallacy and a lot more. We will also go through an analysis in the oil market in general, going through the headwinds and the tailwinds, and where do we see oil settling in this period. Is it the top? Is it over? Are we going to see another shoot up higher in oil prices? We're going to cover that and a lot more in this analysis. So buckle up your seatbelts, and here it is. In focus tonight, there will be blood. Yep, don't think that a crash in oil prices right now is a good thing, because it's not. Of course, we are starting a new, fresh week on the heels of a massive drop in oil prices last week. Matter of fact, last week marked the first weekly decline in oil prices since late April. The problem is, every time we get these dips in oil prices, they tend to recover right away, and this is the nature of inflation under inflationary cycles. The dips in commodities should be bought all the way till the very end. The question is, are we at the very end? Now, when we look at the most crowded trades so far, in June, long commodities happens to be the most crowded trade, specifically long crude oil. Now, a clear rule in investing is when everybody goes all in one corner, when the consensus becomes so loud and clear that a certain commodity or certain assets is going higher, specifically when we see the Johnny-come-latelys who join the bandwagon upgrading these assets or these commodities late in the game. For example, last week, we got upgrades from Goldman Sachs on certain energy stocks. For example, they upgraded ExxonMobil from 104 a share to 117 a share with a buy rating. They also upgraded ConocoPhillips from 130 to 140 with a buy rating. They also bumped Chevron's target from 160 to 181 a share with a neutral rating. Also last week, Bank of America came out and said that oil prices might hit 140 a barrel, even as high as 175 bucks a barrel, okay? And then we got Goldman Sachs once again. Brent oil prices will go higher by another 20 bucks per barrel, according to Goldman Sachs. When all of them jump on the bandwagon all of a sudden, too late in the game, shooting up these random prices, Brent will move higher to 140 or 170 or 200. Well, guess what? The opposite usually happens. And last week, we got a massive drop in oil prices and also in energy equities. Now, this reminds me of 2008. Who can forget that year? And the reason is 2008 marked the highest prices in oil ever. But all of a sudden, the Johnny-come-latelys started to show up upgrading oil targets and oil stocks. For example, this is from May 21st, 2008, from the New York Times. The headline reads, "An oracle of oil predicts 200 bucks a barrel of crude." Now, of course, we all know that this did not happen. Oil prices topped about a month later, at around July 4th, at about 150 bucks a barrel, and that price remains unchallenged even today. But never say never, because who's to say we will not get another shot up higher in oil prices, and we will get to 150 bucks a barrel, if not 200 this time around. But the point of all of this is to learn from history, to learn from the past. And the best example we have for now is 2008. I highly recommend for you to watch the video that I made about a month ago discussing 2008. What happened the moment oil prices topped? Because by the time oil prices topped back in 2008, the S&P 500, the Nasdaq were all declining year to date while oil was surging higher, a dynamic that we're seeing right now in 2022. But the moment oil prices topped, it was not the bottom in the S&P 500. Matter of fact, it was the beginning of the real pain. For example, look at this chart. You got oil in green, you got the unemployment rate in white, and then you got the CPI in blue, and the SPX, the S&P 500 in orange. This goes all the way from 2008, the beginning of 2008, all the way till, let's say, the end of July of 2008, when oil prices already topped. Year to date, from that point, from that perspective, the beginning of 2008 all the way till the end of July 2008, oil prices were still higher by around 29.36% at around 124.44 bucks a barrel. The unemployment rate, on the other hand, shot up higher by 16% year to date at around 5.86%. The CPI, on the other hand, also went higher year to date, maintaining a year-over-year gain of 5.18% and a year-to-date gain of 2.85%, despite the drop in oil prices. On the other hand, the S&P 500 was down by 12.68% at that point. Now, let's fast forward and change the range from the end of July 2008 all the way till the end of March of 2009, when we knew for sure that the bottom is in, the bottom of the great financial crash, of course. From that point, the end of July 2008 all the way to the end of March 2009, the unemployment rate shot up higher by 50%, and it was up 8.7% from the end of July 2008 all the way to the end of March 2009. The CPI, on the other hand, went down from the end of July 2008 to the end of March 2009 by 2.88%, while year over year, it was down by 0.38%. On the other hand, the S&P 500, remember, a lot of folks assume that once oil tops, the worst of inflation is behind us, and that marks a buying opportunity for stocks, in this case, the S&P 500. On the contrary, since late July 2008 all the way to late March 2009, the S&P 500 went down by an additional 38.18%, while oil prices went down by 64.72%, all the way down to $50 a barrel. The moral of the story is, number one, a lot of folks say that the unemployment rate right now is too low for a recession to happen. But back then, right after oil topped in July 2008, the unemployment rate was pretty much normal. At around 5.86, it was slightly elevated year to date, but it was not indicative that there is a recession coming around the corner. You fast forward a few months later, after oil topped, and the unemployment rate shot up higher by 50%. Lesson number two, the assumption that the top in oil prices marks a buying opportunity in stocks is false, evident by the case of the S&P 500 going down another 38.18% right after oil prices topped in July of 2008. Lesson number three, after oil tops, we're not saying that this is the top in oil in 2022. We're just saying that back in 2008, when oil topped in July, the worst of the declines hit oil, not the stock market. So the stock market tended to outperform oil, be it both of them were down, because oil went down by 64.72% from that point on, while the S&P 500 went down by only, and I say only sarcastically, 38.18%. Now, let's use a time machine and go back in time to 2008 and check the sentiment back then, specifically around July 17th, 2008. And all I want you to do is kick back, chill out, and listen to me talking for a few minutes here. But take note of the similarities, because there are a lot of them. The headline from the New York Times reads, "Economic fears slice oil prices for a second day." And this is again a reminder from July 17th, 2008. Concerns about a slowing economy and rising inflation pushed oil prices down sharply for a second day on Wednesday, an unusual dip in the oil price rally that began more than 6 years ago. The two-day decline totaled more than $10.50 a barrel, but analysts cautioned that it was still unclear how far prices would fall and that the respite may be temporary. The drop in oil price contributed to a jump in Wall Street. Are you paying attention or not? What are we seeing today? Tuesday, June 21st, 2022. A massive rally in Wall Street on the heels of a massive drop in oil prices last Friday. Continuing, with most major markets rising more than 2.5%, investors were also buoyed by news that Wells Fargo planned to increase its dividend. Sounds familiar? Like FedEx increasing dividends recently? Anyways, easing some concerns about the stability of banks. Oh, really? The drop in oil was also caused by new evidence that Americans were driving less because of gas prices, which hit a record of $4.11 a gallon, according to a nationwide survey by the motorist group AAA. Again, sounds familiar or what? Because we have a lot of talk right now that we have peak demand. The prices went too high and the demand is going down as a result. And hence, we have peak inflation and the economy is going to recover and inflation is going to cool down. That is just a fantasy, because if you thought inflation is bad, wait till you get the recession. Gas prices have jumped 35% in the last year, were a big reason inflation rose 1.1% in June. The government said on Wednesday that increase caps a year in which inflation has surged to proportions seen by some as threatening the stability of the American economy. In the last 12 months, the Consumer Price Index has risen 5%, the biggest annual jump since May 1991. The U.S. economy is becoming weaker and is unable to to sustain oil consumption at these prices, said James Crandall, a commodities analyst at Lehman Brothers. Rest in peace. He also added, but it is too early to call this a tipping point because of some major risks we might face this summer, like hurricanes or geopolitical events or the collapse of the company I'm working for. Right? The concern about rising costs was echoed by Ben Bernanke, chairman of the Federal Reserve, who provided a bleak assessment of the American economy over 2 days of testimony to Congress, warning that inflation posed a significant risk to the nation's economic outlook. Mr. Bernanke told lawmakers on Wednesday that he saw increased risk of inflation. The rising prices of energy and some other commodities have led to a sharp pickup in inflation, he said, and some measures of inflation expectations have moved higher. The Consumer Price Index report released Wednesday reinforces what many economists, including those at the Fed, have warned about for months. Americans are being forced to pay significantly higher prices, even as the job market weakens and big employers announce plans to lay off thousands of workers. Sounds familiar or what? This is the stagflation of 2008. Now we have the stagflation of 2022. Prices are moving higher, yet we're hearing more and more companies announcing freezing of hiring. The next step is layoffs. A lot of companies already announcing layoffs, the likes of Tesla and Coinbase and many others. There is not enough lipstick to put on this pig, said Richard Moody, an economist at real estate firm Mission Residential. No matter how one slices and dices the CPI data, the bottom line is that U.S. workers are falling farther and farther behind. So again, the point from this article is Wall Street jumped right after oil collapsed from the top. That was the wrong move because guess what? Fast forward a few months later, we were at the heat of the great financial crisis. But there were also systemic risks that contributed from the aggressive and rapid shift from inflation to stagflation to a recession. Now, do we have that systemic risk in 2022? Perhaps. Some would argue it is Bitcoin and cryptos or on the margin lending, but it's certainly not to the same magnitude that it was back in 2008 in the housing crisis. What does that mean? Could this episode end as fast as we witnessed back in 2008, a top in oil and a few months later a recession? Or is it going to prolong and we will see stagflation for a little while before we hit recession? The key to answering this question is, when will oil prices top? And do we have the top already? To answer that question, we have to look at the tailwinds and the headwinds facing oil prices today. The tailwinds, primarily, for now at least, demand and supply dynamics, refining capacity, and the reopening of the Chinese economy. The headwinds, number one, the upcoming Saudi visit by President Biden, and the prospects of a settlement in the Russia-Ukraine war, and lastly, a recession. Let's go through these items one by one, starting with the tailwinds, the demand and supply dynamics. After the Great Panic in 2020, when oil prices crashed and we saw bankruptcies in the oil industry, the monthly crude oil production in the U.S. has never recovered, as you can see from the chart. Likewise, monthly crude imports by the U.S. did not recover to the same levels of back in 2019, for example. So we know that there is a shortage of supply, and this shortage of supply is contributing to higher prices. But, mind you, look at this chart. The rate of oil production in the U.S. right now in 2022 is the same as it was back in 2018. The difference is, back then, oil prices were trading at around, let's say, $70 a barrel. Right now, we're trading above $100 a barrel. So it is not just the supply dynamic that is contributing to these elevated prices. The truth is, the demand is out of whack this time around. The demand is out of control, and this is the contributor to higher oil prices, even though the supply remains the same as it was back in 2018. The difference is the demand is a lot higher today than it was back in 2018. Why do we have such a surge in demand? The answer is monetary inflation, because inflation has always been a monetary phenomenon. You increase the money supply, you print coke out of thin air, and you spread it all over the place. Well, you're going to increase demand artificially in the economy. This will create inflation, and inflation becomes a sustainable phenomenon, and it pushes oil prices higher, regardless of the supply dynamics. That is not to say that the supply problem, the lack of supply in this case, is not contributing to inflation in oil prices. That's not what I'm saying. What I'm saying is a huge aspect of the inflation in oil prices that we have today is due to speculation, excess speculation that was induced and enabled by the reckless Federal Reserve policy. Now, the largest producer of oil in the United States, the Permian Basin, has actually recovered the production levels since before the Great Panic in 2020. The problem is other basins did not recover the production levels since before the Great Panic in 2020. All in all, despite the rise in production from the Permian, we have an overall lack of supply due to other wells not producing, due to a lot of shale production wells going out of business. Whether we're talking about the Permian Basin or not, the number of oil rigs, according to Baker Hughes, did not recover. Even in the Permian. So far, we have yet to recover the rig counts from before the Great Panic in 2020. What does that mean? It means that we're seeing all of these oil producers not investing in new facilities or even recovering old rigs that are now inoperable. Gee, I wonder why. I wonder why oil and gas producers are disincentivized from investing in production anymore. What changed? Perhaps the hostile political environment against oil and gas, accusing these companies of exacerbating climate change, and therefore these companies have to go extinct sooner or later. Maybe that will push management to be disincentivized in investing in production. Why would you do that? And of course, investors, oil investors are saying don't spend a penny in producing more. The tactic from this point on in oil investing, in energy investing in general, is higher prices. Keep the supply down and keep higher prices going, because sooner or later they're gonna kill the industry anyways. So we might enjoy the last ride on higher prices and focus on returns to shareholders instead. Now, another important tailwind contributing to higher oil prices, but most importantly higher gas prices at the pump that you and I are paying, is refining capacity. What do we mean by that? Here's the breakdown to the price of gas that you're paying right now. The majority of the price comes from crude oil prices. These are traded in global markets. Whatever the price of crude is traded at, you're gonna pay that. On top of that, we have taxes, then we have distribution and marketing costs, but we also have refining costs. And this chunk is becoming larger and larger and larger of the overall pie as of late. Now, you might ask why. The answer is, during the Great Panic of 2020, a lot of refiners went out of business and they never reopened again. On top of that, the hostile policies and environment against oil and gas, that in turn disincentivized any company, any refining company, from expanding capacity, even though business is hot and there is a lot of money to be made. But the thinking for now is, let's enjoy higher prices, bigger margins, and better returns to shareholders rather than expanding the capacity of refining. Now, you might ask, well, what about price gouging? Isn't that the real tailwind? Because all I hear is President Biden and the politicians talking about companies, greedy oil companies, price gouging. And the evidence for all of that is oil prices back in 2008 used to be a lot higher than oil prices right now. Yet back then, at the peak, we were paying around $3.50, let's say $4 a gallon. Now we're paying a lot more. We're paying $5+. Isn't this an evidence of price gouging, Mr. Maverick? The answer is no. You know why? Because we have this thing called inflation. And I'm going to let Chuck Todd from NBC explain all of that to you.
If you were to factor in inflation, this is actually not the all-time high for gas, but it is in today's dollars. Now, part of the reason why gas has spiked is not just the price of oil, it's the issue of refining. In fact, 730,000 fewer barrels per day were refined in 2021. That created part of our capacity problems that we had. Much of this, we've had an idling issue. We've got obviously the sanctions against Russia. So you've got 30% of our capacity essentially idle thanks to those sanctions on Russia. Overall, daily capacity has dropped 1 million barrels in our refining capacity since early 2020. So again, this is not the actual oil that we need or are looking for. We have that. It's the ability to turn it into actual gasoline. And if you want to understand what goes into the price of a gallon of gas, we can show you here, but it's the price of oil takes up most of it. But refining capacity is becoming a bigger chunk. You can see down in January of 2021, refining capacity was less than taxes and things like that. Now, the amount of money refining is contributing to the price of gas is growing and growing at a much faster rate than other factors that go into a gallon of gas. So this is the biggest problem we're dealing with. It is the ability to return more oil into gas. And as you can see, again, this is not the all-time high. The all-time high was back in 2008. But of course, in today's dollars, it is over $5. But if you're looking back at previous dollars, we would be at about $3.50.
I don't know why they're keeping the annoying music while the guy's talking. Like, can you tone it down a little bit so we can hear what he's saying? But anyhow, the point is, right now, factoring in inflation, you're actually paying less than you paid back in 2008 for a price of gallon at the pump. So that settles that, because we have a lot of talk on Twitter. This is an evidence of price gouging, and it is a colossal of stupidity. Ever heard of inflation before? But here's the problem, folks. The refining capacity did not grow in the United States since at least 2018. Matter of fact, it has been going down. So this has been a problem in the making for a long time, and now we're paying the price. So what is the easiest alternative for now to expand refining capacity? Because President Biden is telling oil refiners, produce more gas, fewer profits, come on man, as if they have some sort of a magic wand to produce more. The refining capacity is mostly found in China, the only country right now on the planet that has the refining capacity to alleviate this problem is China. Now, China is under draconian lockdowns, and guess what? The operating rate at private refineries in China collapsed a few months ago. So that's a no-go. Chinese refiners are not going to come to the rescue. The contrast between China and the U.S., where refiners in some areas are running at close to full capacity, reflects a tectonic shift in the industry over the last few years. European and North American plants have been shutting down, a trend that was accelerated by the thing, while most new facilities are being built in the developing world, particularly Asia and the Middle East. So if you didn't know, now you know. Refining capacity is a massive tailwind pushing oil prices higher. Then we have the Chinese reopening. Whether that's going to last or not last, who knows? But for now, we know that the Chinese have a large appetite for crude, and this is contributing to higher prices. Over the weekend, we got the news that China bought $7.5 billion worth of Russian energy products. So much for the sanctions, right? Sticking a tapuin, brah. Turns out we're shooting ourselves in the foot. China continued to snap up Russian energy products last month, including a record quantity of crude oil, lifting purchases to $7.47 billion, about $1 billion more than April and double the amount of a year ago. The increase in shipments came as the war in Ukraine entered the fourth month and other buyers continued to shy away from Russian oil, gas, and coal. Chinese demand also started to show some improvement as virus restrictions were loosened, easing logistical snarls and allowing industrial production to rebound. China's total imports from Russia accelerated in May, surging 80% on year to $10.27 billion, as Beijing continues to offer support to an otherwise isolated government in Moscow. Crude imports rose 55% from a year ago to 8.42 million tons. Are you paying attention or not? The Chinese are consuming more oil than before, with Russia overtaking Saudi Arabia as China's main source of oil, according to customs data released on Monday. On the other hand, Russian liquefied natural sales rose 54% to 397,000 tons, despite a 28% decline in China's overall purchases of the super chilled fuel. So all in all, net, they're buying less gas, be it they're buying more from Russia, but they're buying more oil than before when it comes to crude, and they're buying more of that from Russia. So the Chinese appetite is healthy for now, and it will continue to keep a floor on oil prices, at least for now. Now, what about the headwinds for oil? Number one, the upcoming visit to Saudi Arabia. The assumption for now is Joe Biden is going to beg MBS to release more barrels, and by doing so, we will have an increase in supply, and this will push crude prices down. Now, here's the problem. Number one, if increasing the supply was the remedy to higher oil prices, then how come the release from the Strategic Petroleum Reserve, 1 million barrels per day, how come that did not alleviate the rally in oil and the insane prices we're paying at the pump? Number one. Number two, let's say the Saudis expand their capacity to maximum. No more barrels that could come out of Saudi Arabia or the UAE, or whatever country you want to pick. Isn't this a tailwind for oil to go higher if the demand remains the same, or the demand continues to move higher, let's say due to more Chinese reopenings? Because the thinking will go, well, if oil prices don't go down, after expanding the capacity to maximum by Saudi Arabia, then we're shit out of luck. There are no more new barrels that can be pumped, realistically speaking, and hence we succumb to the reality that the demand right now is unsustainable. But anyhow, I want to take the opportunity here to talk about our incompetent Energy Secretary, Granholm, who shouldn't even be trusted in handling frogs at the zoo, let alone handling the nation's energy policy. Here's a reminder of who Granholm is.
Let me cut to it, if I may. In Sturgis, Michigan, it is $2.89 a gallon. I guess that's better than in California. What is the Granholm plan to increase oil production in America?
Oh my God, that is hilarious.
So here she is, laughing and giggling. Oh, that's hilarious that we have to increase oil production, oil supply. That was last year. She was laughing about it. Is she laughing now? But most importantly, who is she blaming for the insane prices that we're paying at the pump right now? Take a look.
Tough time for the country, tough time for the administration here because Americans are pumping gas. They're seeing the numbers go up and up and up. Simple question off the top. When they're frustrated seeing that price, where should they place their frustration? Who should Americans be angry at right now?
Well, they certainly should be angry at Vladimir Putin.
Of course it's Putin's fault. Who else? Putin increased my rent too. The prices that are paid at the store for food. My utility bills. That's Putin's fault too, right? I had no idea that Putin has so much power, so much control over us, because I've been told for years that Russia is insignificant, it's just a mere gas station, and that's about it. I had no idea that Russia controls everything in our lives. But here's Granholm again over the weekend, not taking responsibility at all, dodging, deflecting, and not being honest with the American public. Take a look.
So on that note, the White House said this week that President Biden could use the Defense Production Act to help solve the problem. Are you developing plans to use that in order to increase the domestic pipeline?
Let's just say the president is prepared to use all of his authorities to do what he can to increase supply. Supply, of course, just to set the stage on this, though, Dana, for everybody, of course, oil is traded on a global market. This issue of supply is hitting every country around the world. Every country is paying high prices for gas. If you were in Singapore, you'd be paying $9. Canada, it's over $6. Bottom line is we have to, all countries, increase supply in this moment because demand is also increasing, especially as countries like China will be coming out of COVID. So you've got an upward pressure on prices. So the president is doing everything he can within his power, including releasing 1 million barrels per day at the Strategic Petroleum Reserve. We've got to replace the barrels of oil that Russia used to export around the world, and that now is not available because of the war.
Yeah, is it really the war or is it the sanctions that are backfiring on us? In either case, both were preventable, the war and the sanctions. But we chose not to do that. We chose to go with the war. That's the reality. Because we thought that Putin is going to get humiliated easily, short and fast, and that's that. They did not even entertain the possibility of any consequences. And here we are, which leads us to the next headwind for oil, and it is the Russia-Ukraine war ending. Now, you might have noticed in recent days that the propaganda reporting by our media has changed. The narrative is slowly but surely changing. In the beginning, it was Russia is being humiliated, they're losing thousands of soldiers, the Ukrainians are winning, we just have to push a little more. More weapons, more money laundering, that will do the trick, and Ukraine will win, Russia is going to retreat, and that's that. And they've been pumping stories, false stories, day after day, night after night, selling you that narrative. Now they realize that the opposite is happening. The Russians are gaining ground, important ground in Ukraine, and the sanctions are backfiring, and we are at the brink of a massive crisis here, an inflation crisis in the West and a hunger crisis in the developing world because of the shortage of wheat, corn, etc., etc. Now the media all of a sudden is loose about publishing Ukrainian losses, for example, and even Biden suggested that perhaps a carve-out of certain territory to the Russians would be part of a settlement. But that is up to the Ukrainians, of course. That is a massive change in tone by the Biden administration, who said before that nothing short of a victory is acceptable. And now we're seeing more cracks in the West's unity over Ukraine. Why? Because each country is facing massive inflation. We have a problem in the UK, we have a problem in Germany, in Italy, and this is unsustainable. These countries need energy products right now to sustain their economic growth, and the alternative is not available for now. It's going to take years and years to find the alternative of Russian energy. So now we're hearing more and more talk about perhaps European leaders visiting Ukraine and convincing Zelensky that it is over, try to find out a deal with the Russians. We can't support you any longer. We can't keep supporting you any longer because soon enough, our economies are going to dip into a recession and our people are going to be angry. The media's change of tone is also an admission that Putin still holds the cards when it comes to global energy, that the sanctions have backfired and they're causing stagflation across the globe, specifically in Western economies. Yes, maybe the sanctions are hurting Russia in some way or the other, but they're certainly destroying the American economy, no doubt about it. And now even Politico has published a piece saying negotiating to end the Ukraine war is not appeasement. Oh, really? Just a few weeks ago, if you argued that perhaps a settlement negotiation is the way out from this war. You were accused of being a Putin puppet, a Russian propagandist, but now even Politico magazine is arguing that negotiating is the way to go and it's not appeasement. What's going on here? A massive change in narrative. November is around the corner. They know it. They know that this is unsustainable and they have to end the war at any cost and relieve Western economies from this inflation. Even CNN is changing course. Take a look.
Of course, Russia is paying a heavy price for waging this war, what it calls its special military operation in Ukraine too. It's estimated to have lost thousands of troops and countless tanks and other armoured vehicles, some of which have been placed here in the centre of the capital, Kiev, on public display. But nearly 4 months into this grinding and relentless conflict, Ukraine seems dangerously outnumbered and outgunned. From the Black Sea, Russia's naval bombardment continues apace. These 4 cruise missiles fired at a warehouse of anti-tank weapons supplied by the United States and its allies, according to the Russian military.
And these are, by the way, your billions and billions of dollars worth of weapons, courtesy of the taxpayer. They're being blown up in smokes by the Russians. Billions of your taxpayer money, poof, gone. And now even CNN is reporting on that. That leads me to an interview with Representative Ro Khanna from California, who we thought initially is the hope and the remedy for this corrupt political regime. But of course, Ro Khanna joined the rest of them and he sold his soul out. He's all in for the war, and it is absolutely hilarious how confused and irrational he sounds in this interview talking about oil prices. Take a look.
Back in October of last year, when you were talking to some of these CEOs and praising BP and Shell, the CEOs, for reducing their oil production over in Europe, and saying, are you at this point embarrassed as an American company, to Chevron CEO, are you embarrassed that your production is going up while the European counterparts are going down? Don't you want our companies, our domestic companies, to increase production at this point? That was clearly not the right action to be asking these CEOs to do back in October. Was it?
Joe, it's a fair question. I think we have to distinguish between the long term and the short term. Of course, we need short term production to go up. What I was talking about in that clip, and if people see the whole testimony, is how do we diversify our energy sources over the long run.
So he wants oil producers to have a long-term strategy and a short-term strategy. The short-term strategy is pump, 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 drill, baby, drill. Because we need it. Us politicians, we need it. November is around the corner. Come on, man. But your long-term strategy is please go bankrupt. Please end yourself. This is what Ro Khanna is saying, which is absolutely absurd. And then he goes on with another solution, this time around export bans to reduce the price that you and I are paying at the pump. Never mind the fact that he supported full-heartedly the proxy war in Ukraine and assured our European allies, go ahead, play tough with Russia, don't take their oil and gas because we will give you oil and gas. Now Ro Khanna says, let's impose an export ban. Take a look.
And one of the ways we can do it is to have an export ban. Here's what I want to understand. Why are we sending more oil to other countries when we have a problem here with supply. We never used to do that before 2015. We could have that ban now, and it would dramatically lower gas prices.
Now, he's completely irrational, babbling all over the place about an export ban and about a short and long-term strategy for oil producers. But watch how fast Becky Quick catches him with a nasty one. Absolutely slaughters him. With what? With rationale and logic. Take a look.
We could have that ban right now, but it would really put the screws to our friends and allies in Europe who are dealing with some big problems caused by Vladimir Putin in Russia, and I don't think we want to do that. And, Ro, I think the honest answer to the honest question on some of these things, too, are you want short-term production, not long-term, and I think we want refineries to be able to pump out more gasoline right now because that's part of the problem. We don't have the refinery capacity. But those are not investments that businesses are going to make if we are telling them this is for the short term. We want them to spend billions of dollars to make additional investments that, by the way, we don't want those investments to continue producing a decade from now. It doesn't make financial sense. There are consequences when you say you don't want things over the long haul. Businesses stop spending CapEx, and that's what the oil companies have done. It's a little disingenuous to say we want you to produce short term, but then we're going to take away your ability to make money off those investments, those major investments we've asked you to make.
Well, Becky, I think that's not what the position of the party is.
Yeah, it's not the strategy. You got me with a good one. I should shut up and move on. That's what you should do, because she got you. You're done. Really? You're asking oil producers to pump now to save your ass, to save your political career, but destroy themselves in the future? No thanks. You want to have an export ban when you already assured our allies that you're going to support them with oil and gas? Now you're saying cut them off because we got a problem here at home? What's going on here? Obviously, what's going on is another example of your beloved incompetent politicians. Now, here's the last headwind, and perhaps the most important one, against oil, which is a recession. Now, you might be in the camp of, let's say, Janet Yellen, for example, who says that I don't think a recession is inevitable. This is the same lady who told you that inflation is transitory. Take a look.
I expect the economy to slow. It's been growing at a very rapid rate as the labor market has recovered and we have reached full employment. It's natural now that we expect a transition to steady and stable growth.
At this point, nobody believes Janet Yellen at all. Anything she says, the opposite will happen. She shouldn't be at her job right now. She should be fired. But this is the same narrative, by the way, that we heard from these senile leaders. Even back in 2008, Fed Chairman Bernanke said, there is no recession. He doesn't see a recession. But we now know that Bernanke should have taken an eye exam back in 2008. Because here's the thing. Oil is not going to rally amidst a recession. If there is a recession, if we see the economy shifting from stagflation to a recession, oil is going to crash. And that crash would be bad for oil, but also bad for the economy and bad for stocks. It's not going to be a buying opportunity when oil crashes based on recession prospects. And we're already seeing more and more evidence of the upcoming recession. For example, the U.S. factory output declined for the first time since January last month. On top of that, the Philly Fed Manufacturing Index was an absolute disaster, reading negative for both current and future activities. Now, when the Philly Fed Manufacturing Index is reading negative, is this an indicator for upcoming period of growth in the economy or an upcoming recession and contraction? With that being said, the index in the Philly Fed Manufacturing Index for prices paid and prices received remain elevated for now, which means we are still in stagflation. But the next step is a recession. When prices go down, they're not going to go down for the good reasons, folks. They're not going to go down because inflation turns out to be transitory. They're going to go down because stagflation is becoming a recession. And now we have all of these banks coming out of the woodwork predicting the chance of a recession. Last year was no chance. There was no way the U.S. economy is going to be in a recession a year from now. Well, now Goldman Sachs says 30% chance for a recession. Bank of America goes higher and says 40% chance of a recession next year. And then we have another firm going 75% chance that we're going to see a U.S. recession within the next 2 years. JP Morgan goes as high as 85% of a U.S. recession. Can I get 95%? Anyways, JP Morgan says 85% chance of a recession because of the stock market price action. And the gloomy talk about an upcoming recession becomes a self-fulfilling prophecy. And lastly, everybody talks about the cushion, the unemployment cushion, that there is no way we're going to have a recession next year because look at unemployment. Unemployment is so low, how could you have a recession when everybody has a job? Here's the problem. Back in 2008, when the year started, the unemployment rate was at 5%, which was normal at the time. You fast forward a year later, that 5% unemployment rate went as high as 10% before peaking. So saying that the low unemployment rate is a proof that this country is not heading into a recession is a fallacy. The unemployment rate has always been a lagging indicator. You see, companies are not going to fire workers right away when we start to see signs of a recession coming. It has to get really bad, their stocks have to crash, the economy has to tighten, and then they start to get rid of employees. And that unemployment rate could shoot up fast, rapidly, and move from 3.5% to 5+ to even 8% in just a few months. All what needs to happen is a decline in the pace of economic activities in the services sector of the economy, which is coming, by the way, because consumers are facing inflation. They ran out of savings. For now, they're swiping those credit cards up and down, up and down, up and down to survive and spend on these services, including travel, leisure, and hospitality. Now, the majority of the jobs we recovered, not created, recovered since the Great Panic of 2020 are leisure and hospitality jobs. These will be lost so fast, you're not going to even realize what's going on. The moment the consumer stops spending on traveling and services, in this case, hospitality and leisure, because they maxed out the credit card, and oh, by the way, the stock of their company went down big, now the company has to lay off workers, well, the spending is going to stop. Once the spending stops, all of these excess jobs with inflated salaries, I might add, in the leisure and hospitality sector of the economy will be lost so fast. So here's the bottom line, folks. Yes, oil prices took a massive leg down on Friday. Is it the top? Is it going to recover again? At the time of the recording of this video, we have absolutely no clue. But the take from all of this is the following. Not if, but when oil prices crash, it will be an ominous sign, not a good sign, that the economy is going to recover or stocks are going to recover. It's going to be an ominous sign that we are moving from stagflation into a recession. And if you didn't know, now you know. Folks, this is all I got for you for this video. But stick around, the technical analysis of the stock market activities today will come out later this evening. For now, thank you for listening, thank you for watching, and I will talk to you again soon.
I can't keep doing this on my own. With these